Right, so you're joining a webinar today organized by BerChain in collaboration with Pacuna, one of our members. BerChain is a member-led nonprofit association in Berlin. And there are a couple of things that we do, but most importantly, we connect the Berlin blockchain ecosystem. We organize events, these days mostly online, but we also have a hybrid event coming up. We explore new use cases. We have connections to public administration, etc., exploring how we can increase the use of blockchain in Berlin and how we can keep promoting Berlin and positioning Berlin as a blockchain capital. Today, we are joined by Werner Hoffmann, who is the CEO and founder of Pekuna, and who will tell us about taxes on crypto. I think this is one of the subjects that is that's actually quite interesting, but also quite mysterious to some that are not both experts on crypto and taxation. And luckily, we have someone in our middle, in the person of Werner, who actually is an expert on both. Werner has previously worked for the state office for taxes in Bavaria, and is now with Pacuna, where he's the CEO and co-founder, helping crypto traders, investors, and also tax advisors with the taxation side of cryptocurrencies. We're very happy to have him. We also are very happy to have Pekuna as a member. And I think as soon as Werner is ready for it, we're very happy to get started. Are you there, Werner?
Hi, Sylvan. Yes, I'm here.
Perfect.
Thank you for the warm introduction.
Absolutely. And then with that, I'll leave it over to you. There's just one more household thing that I'd like to mention. So if there are questions for Werner throughout the webinar, please use the Q&A function. There's a Q&A button on the bottom of your screen, and that will very conveniently pop up the questions on my and Werner's screen, and we can then address right after the webinar. But please keep them coming already as you have questions, and we'll address them right after. Right. Having said that, I'll leave it up to you, and I'll be back for the Q&A part.
Thank you. Then let's start. So yeah, also from my side, thanks for joining this very interesting webinar. I know it's a Thursday evening, and you probably all have better things or more interesting things to do than talk about taxes. But it's still very important, and that's actually a very interesting topic because we are here on the forefront of some new legal topic that's evolving. And I want to give you a quick overview. So we have around an hour to go through the basics of taxes on crypto in Germany. So this is country specific, so be aware that's only Germany what I'm talking about. And I hope you will learn a lot during this next hour. So Sylvan already introduced me a little bit. My name is Werner Hoffmann. I studied tax law. I worked for the state office for taxes. And then on the side, I studied computer science. I have a degree also in computer science. That's also when I first got in contact with Bitcoin, with the blockchain, with the, I started from a technical perspective to be really fascinated of what is going on. And then after the big price increase in 2017, I realized, oh, wow, that's really complicated. I need to do my taxes, and even I am struggling. And if somebody, then I should know how to do that. So that was when I first realized, wow, that is a really complicated topic. And I have some knowledge here that might other people find very helpful. And that's actually what I'm doing now. So since 2019, I started this as a company, working full-time on it for it now, more than 1.5 years, almost 2 years by now. And helping people with their crypto, with their taxes, and all kinds of regulatory topics, also working a lot together with tax advisors. That's actually the main focus and how we started, but now more and more also that people directly reach out to us. So, yeah, honestly, I'm just here for the Lambos. Let's face it, that's the real reason why most of us will be here. And the space is super interesting. There is a lot of money to make, but wherever money is to make, the tax office is not far away. And in our very new, very specific topic, there is not a lot of laws, not a lot of guidance that we can use. So we have to, yeah, really work on back practices and try how can we avoid risks, what do we know already, on what can we build, what is the general law, and so on. And first, why is it so complicated, taxes for crypto? It's special because usually we have some other entity that pays taxes for us. So if we're employed, our employer pays the taxes for us. If we're buying something, the VAT needs to be paid by the shop that we buy in, by the business. If we get capital interest, then the bank takes care of the capital interest. Only in crypto. It's decentralized. There is no central unit, nobody who takes care of our taxes. So that's why we need to do everything by ourselves. And that's also what makes it so complicated. That is a way that most people have additional income with crypto and that they need to declare. We are in the area of income tax. So we have different kinds of taxes. And if the normal trader who buys, like, let's create a basic case, one person buys one Bitcoin for a price of, let's say, 10,000 and sells it for 12,000. Then the 2,000 gains he made are part of the income tax, and they're the so-called privates Veräußerungsgeschäft. So it's a like asset deal, you could say. And now we need to calculate the gains. The gains is the price we sold our asset minus the price we bought our asset. In our example, 12,000 minus the 10,000 is 2,000, minus eventually fees and other things that go on top here that we also are able to deduct. Also, we can deduct things like if we buy a ledger, if we do any like trainings, courses, if we invest in something that we need to have these income, then this is also a cost related to income that we can deduct. So, but it gets really complicated if we are not just buying one Bitcoin and selling the same Bitcoin. It gets more complicated once we buy, sell a small part, buy again, and so on. Because then we need to get an order. What was the asset we just sold? What was the price we originally bought it? In Germany, usually there is the first in, first out method used. It's the most commonly accepted. We've also talked to some tax offices. They only accept that. And also for the trader, this is usually the better one. But you can already imagine that makes stuff kind of complicated because you don't always sell the same amount that you bought. So you can buy one, then sell half, then buy another half, then sell one. And then you have to like calculate the asset price for every transaction. And that's what actually makes the whole process so complicated. And that's also where like the simple Excel sheets and our simple bookkeeping usually starts to fail if stuff gets a little bit more complicated. And then also, of course, there's not only one asset. I'm always using Bitcoin as an example, but there is, of course, you know it, thousands of cryptocurrencies that can be traded against each other, where we have the next big problem. If we trade one cryptocurrency against another, we also need to figure out what is the price at the time when this takes place. In Germany, we are really lucky. Most of the people are not aware of that, but regarding crypto, we are in a tax heaven here. There is this long-term versus short-term. Every asset you hold for more than 1 year is tax-free, is completely tax-free. Usually people are not aware of that, but that's a huge deal. You can do a lot of stuff just with that one regulation to have all your assets tax-free. Like we worked with a lot of people and they had millions of gains that they have to pay 0 taxes. And also Germany is the only state I know from who really has this very, very trading friendly regulations. So that's the easiest thing you can do to say you want to avoid as much hassle as possible regarding taxes. Just make sure to hold everything for more than 1 year. It's a huge deal that we are able in Germany to have that. Also, a lot of people advocate for we need special tax regulations for crypto. I'm not sure if that will benefit the crypto community. I expect that it would be worse than our really awesome regulation that we have right now. Now the first tax tip where you can really save a lot of taxes, you can use the so-called account separation. I talked earlier about first in, first out, and I talked about the 1 year period. If you combine these two things, and now you know that every account gets calculated separately, you can really construct and avoid taxes legally by having just a really good setup on how you do it. So you have like one account where you do all your short-term in-out trading, playing around with crypto, and then you have another account where you make sure everything in there is held over 1 year, where you have like the big gains. And that's also a really fortunate thing we have here in Germany, that this is possible. So not only everything over 1 year is tax-free, also we can separate accounts. So just different wallets, different exchanges, everything that helps to really separate your assets is enough to have these FIFO calculations separated. And that's also a huge deal if you think about what's a good strategy for crypto trading, and what's a good strategy to avoid tax, like tax optimized trading. It's a big thing, because if you think about it, you could say, oh, I sell after 11 months and I sell now, or I wait for another 4 weeks. I maybe have a chance of losing 20% of my gain, but I also avoid 40% of taxes that probably many of us have as a personal tax rate, because crypto is not part of the capital gains. Crypto is always taxed with the individual tax rate, and the individual tax rate you find roughly on your payslip. If you want to have a rule of thumb, what's your personal tax rate? Take your payslip and calculate how much taxes you pay there. So what we need to look out for is taxable events. What are taxable events? And that's always when we need to calculate something. So we have in a logical order, we have first the buy event. The buy event is of course not a taxable event, because there nothing happens. We just accumulate assets. These assets are in our private assets, and nothing the tax office needs to know about or needs to care. So everything you just hold, you're good. First taxable event, if you sell it. That's the one we already talked about. Usually against any fiat currency, doesn't matter if it's euro or US dollar, doesn't matter if you leave it on the exchange, doesn't matter if you reinvest it, whatever gain or loss you made with that taxable event, like the selling part, you have to pay taxes on. The next one is the trade. You trade one cryptocurrency against another. You use your Ether and buy some token for it. Also taxable event. At that time, you sold Ether and you bought another one, another token. And that's especially complicated to calculate, because we need to know how much was the purchase price now and what's the selling price for this specific asset. So we need to look up a price in some kind of database. This could be CoinMarketCap. This could be that's a huge discussion what price to use there. I probably could talk just an hour about pricing and pricing services and how to calculate the best price and what's a reasonable price to go to the tax office. And overall, it also doesn't matter that much because you can really more shift around gains and losses than avoid them. So taxable events, we talked about trade. Next one is using it for purchases. That's a big one because a lot of people don't think about that. If you use your Bitcoin, your Ether to buy something, you buy a whatever ticket for a crypto event, you buy your ledger, you buy your coin tracking account, whatever you do that you can pay in crypto, it's a taxable event. What's not a taxable event? Everything that has just to do with your exchange, putting money on your exchange or take it off the exchange, not a taxable event. Yeah, so I think that's the most important one. Then let's check the time. Yes, we do have time to talk also about mining. Mining is something that it gets really complicated because the mining activity is considered a business in Germany. There was a lot of discussion going on, especially that was already a couple of years ago. And the most people say that mining is a business activity, and therefore as soon as you start mining, you automatically create a business. That comes with a whole lot of problems. For example, all the assets you create, like the mined Bitcoin, the mined Ether you get, are now business assets. And now you have to do all kinds of reporting, accounting. You need to create your financial papers. The taxation is completely different. You don't have your 1 year holding period. Everything you do is taxable, so it's a lot more, and it's a lot more of reporting and stuff. So that's really complicated, and a lot of people managed to create a business without knowing. So that's why I just want to mention it here. I don't want to go into all depth because it could be really complicated. Also, a topic I always mention when talking about business assets is VAT. Bitcoin is considered as a money-like asset, so that is good enough for that we don't have to pay VAT. That is actually a really big deal, because otherwise every asset bought from a company, for example, an exchange, would cost another 19% more in Germany because you have to pay VAT on it. And that could basically kill the crypto market by just having really bad regulations here. But luckily, there was very early on a law case going on for whole Europe, where it was decided that no assets or crypto assets in general, they were only speaking of Bitcoin at that time, but crypto assets in general are widely considered money-like, and therefore there is no VAT on these assets, which is also very lucky for us. Otherwise, it would probably not be where it is right now. So, and over the last year or so, there were a lot of very new use cases, new assets developed, new methods developed, how to create income. I mean, you probably know what's behind that: staking, lending, airdrops, hard fork, and so on. I also don't want to go into detail for that because that topic is a whole seminar for itself. So I could definitely talk a lot about every single one of these. But just to give you a brief introduction, what's here interesting. So we went pretty quick over our basic case, that we have like some time now to look into these special cases a little bit more. I assume all of you probably had some basic knowledge already on the standard trading use case, but let's now do some dive into the more interesting topics. So here we need to see, let's go into staking first, because staking is like perfect use case for all the others, and we can adopt a lot of the learnings. So for staking, you need assets. Let's use Ethereum as an example. I know they're not there yet, but it's just something that probably everybody knows. Let's say staking is available for Ethereum and we want to do staking with Ethereum. So first thing we need to look into is, like, we bought our Ethereum, not taxable. Now we put our Ethereum in some form of staking. Either we use a staking provider, we put it on an exchange, we do the staking ourselves, or we have some other pooling service whatsoever. Like, there's a lot of solutions out there that do staking actively for you. That thing is already discussed if that might be a taxable event. Our very clear opinion is no, definitely not, because even if I give it to some pool, some provider, someone else, it is still my asset, and I can move my assets around whatever I want. So moving my Ether from one exchange to another exchange is not a taxable event, and it should be absolutely the same for staking. If you put your coins into staking, they're not taxable. But even here, the very first step, there's already discussions going on if it might be a taxable event. So then we're getting new coins, the staking rewards. Then we are at some point selling the staking rewards. Then we are taking the original coins out of staking at some point, and then we are selling the original coins at some point. So you already see we have a lot of things that happen, a lot of transactions, and for every single one, we need to go really into detail what that means for taxes. And basically every step has multiple opinions that people have. And also, if you argue this or the other way on one step, that affects how the next step is affected. So staking rewards. Once the staking rewards come in, most people consider it as a capital income. In the capital income, there is some paragraph that says very widely, every earnings you have related to assets through doing, not doing, is taxed under that. That is a very broad paragraph, and therefore you could definitely put it into that regulation if you want to, but there is also good arguments to say it is just not taxable at all. Like, there is no paragraph in the German tax law that works for this staking rewards, and therefore, if there is no regulation why it should be taxed, you can argue that it's overall tax-free. That's the first thing. Then what happens if we sell these staking rewards? Here we very clearly, we did not have the buy process, which is needed to be in the privates Veräußerungsgeschäft, the private asset deal. Therefore, it doesn't fall under that. So you can easily argue that also selling the rewards you get through staking is tax-free. So we have now putting it into staking, not taxable. Earning staking rewards might be taxable, might be not. Here it a little bit depends on how good you argue and what's the legal foundation, and also yeah, what's the exact use case, how do you do your staking and so on. Was it an active process, or did you just get the staking reward? So that needs to have a little bit more details to make a decision here if that's taxable or not. Then selling the staking rewards, not a taxable event. Taking assets that are locked out of staking, same thing. It's like moving assets that belong to you around, either from one exchange to another, from a staking provider to another. I mean, there is many exchanges that even stake for you. So also here, is the opportunity that you just say, okay, at some point you have it on an exchange that does staking for you, then you move it to, I don't know, a ledger that doesn't stake for you, or a paper wallet or whatever. And also here, same. So it's just moving it around. But remember, you still need to calculate your first in, first out time period. And therefore, you still need to find the original matching buy process. So that it gets really complicated. Once you have so many transactions in between, so much moving around, you have a locking period in between and stuff, then it gets really complicated what assets were sold at what time, always under this first in, first out calculations. And now it's getting interesting. So at some point you want to sell the original coin that you used for staking. And here is currently a big discussion going on in the crypto tax scene. It's not that big. It's like 20 tax advisor all over Germany, and some experts like us who are part of this group. And there's a lot of discussion going on if the holding period stays with 1 year, because there is also another holding period that says assets that were used for creating income are not with 1 year, they're 10 years. And here you really need to get into detail and how you can argue if it's 1 year, if it's 10 year. It's always also a little bit of a chance. What does the tax person for your specific tax case do? What happens the next couple of years? 10 years is a long time. So here it's really, a big discussion going on, a lot of legal insecurity, how that is dealt with right now, how that can be argued, and what the future situation will be like. And now you already seen like just the one staking case, how complicated that can be. And it gets even more complicated if we now consider all the other cases, like combined with lending, airdrop, yield farming into that, leverage trading, and so on. So there is a lot of stuff you can like combine on top of each other. We all know these crazy use cases that you can do these days. And there it gets really tricky how to do your taxes, and also what happens with the original coins, what's the holding period, what has to be paid taxes with at what point, and so on. So then I quickly want to go into the whole topic of tax reporting versus tax filing. Tax filing is the final number that goes into your tax declaration and handing the tax declaration into the tax office. That is just one number. And often the tax office will ask for further explanation where this number comes from, why is it there, how you calculated it, and so on. And that is tax reporting. Not always they ask, sometimes they do, sometimes they do not. But it's always recommended to do a proper tax reporting. Why? Tax reporting helps you to get out of any problems with tax fraud, because everything the tax office knew at one point, or they could have known at one point, goes to your advantage. So let's say you do the craziest scenario now with yield farming and staking and so on, and have a crazy case here, and then you argue that everything is tax-free. And right now, it's possible to argue these things because there is like no law cases, almost no scientific papers going on around these topics of how to tax that, what is correct. And therefore, we have a very high quote of what the tax office just believes is right, what we are doing, and follows our argument. But if you don't tell them that that's what happened, they will always be able to get into whatever you have filed, because it's not reported. Therefore, really create an attachment where you show every single trade, what happened. Once they are able to understand everything, no matter if they do or they don't, most likely they don't. Never forget, we are like way ahead. We are like so early. You always need to remember that we are so early. Tax offices are always behind, like 1 or 2 years. Like at the moment, 2019 is the new stuff for them. So still they do 2018, 2017 cases. If we remember back what was going on in the crypto space in 2017, that's like, yes, so far ago. We were still like the bull run was just over, and or no, it wasn't even started. And yeah, so they are always like a couple years ahead. And especially with topic like those, most people in a tax office have never had a case with crypto, probably have never heard of crypto. So therefore, tell them everything. As long as you report it, they will most likely go along with whatever you report to them. And once it's reported, you're fine. You get your tax assessment, the 4 weeks period where you can still file a complaint is over, and then it's final from both sides, for you and for them. And that is to protect you. That is a legal protection for you, that you can at some point be sure that the tax office doesn't come and asks for whatever happens in the past. They want to have money back. So it's really important to have a report about everything that happened and how you calculated stuff and so on. And yeah, that is also the core product we at Pekuna are offering. So we are basically providing tax reports for traders. We are very often working together with tax advisors. They're usually the one who request our services because they know how important it is to do your tax reporting properly. More and more we get also requests from traders, and therefore I really recommend to do a good tax reporting, not only the tax filing. So yeah, that's basically put it into your tax declaration. That's the section. It's called Privates Veräußerungsgeschäft, where you have to add it. And then after you get your tax declaration, you are really fine. And 2010, a long time ago, but that's how far the tax office is allowed to go back. If you say you ignore it, you don't do anything, you don't file your taxes, you don't mention it in your tax files, they are allowed to go 10 years back. Even if you said you did some trades, but they were all tax-free, still report it, because whatever they knew, you will never get in trouble for. And we don't know what happens in the next couple of years. At the moment, we all think 1 year period for tax-free. That's like common knowledge these days. In a couple of years, I can totally imagine that the tax office realizes on how much they're losing in this area, and that they try to find some way to get into taxation of crypto. That's also why I'm super careful with this whole 1 year, 10-year period. A lot of people are very sure it will be only 1 year. We don't know what happens the next couple of years. We don't know what happens in the whole space. And it is really possible that just like common knowledge, the common opinion changes on it. Is it a 1 year period? Is it a 10-year period? Is it an asset at all? Is it part of capital gains? Then we are in a completely different area. And basically everything I just told you is wrong. Unlikely, we don't think so. Also tax office, also like there is the first, yeah, they have like sometimes these statements. They are very thin, like I think half a page is the most we got so far regarding crypto. They don't really tell anything, but everything goes. We are in this private asset deal area, but also that could change. That's just an opinion right now. And therefore, it's really important to file everything and to report everything, even if it's tax-free, because that's the only way where you can say, yeah, now you're absolutely safe. Whatever opinion changes, whatever tax law changes, whatever the new opinion on staking and so on is, your tax declaration cannot be changed as long as they could have known that this case was part of the way you calculated your taxes. That's also why it's important to not only put the final number in your tax declaration, but also send a really detailed report of everything that happens, really every single transaction to them. And then you can say, you always knew, it's not our fault. You could have had a different opinion back in 2020 when you did my tax declaration. You didn't. Now everything is fixed. And yeah, that's like my core message I want to give you for today, and that I hope you take from this whole course. It's really important, and that is something that I don't hear very often. Like, people often discuss about some details, but really the good reporting is key to everything. Like, no matter what in a Telegram group is discussed, the tax office doesn't care what opinion some people in a Telegram group had a couple years ago, because they are the ones who will finally make the decisions, and they only can do that, and it only lasts if you actually reported it, and report means write everything down. And another thing I want to talk about is tax avoidance versus tax fraud. I already said in the beginning, we are in a super lucky state here in Germany. We have a lot of options, possibilities to really avoid taxes, totally legally avoid taxes, and use those methods over tax fraud. Tax fraud usually doesn't pay off. I mentioned 10 years back. So 2010, basically Satoshi still could get fined for his very first Bitcoins mined if he has German citizenship or is a German tax citizen. Yeah, there is a lot of ways to reduce your tax rate. Use those instead of trying to do tax fraud. I hear often it's decentralized. Tax office will never find out, all these arguments. Yes, you might be right. Right now, that is actually the case. Tax offices are behind. They're way behind, but they catch up. And we don't know what happens. There is the next exchange that gets leaked. There is, for example, Coinbase just gave a lot of data to the IRS. There is agreements between German and US tax offices. So I am expecting that every Coinbase trader will get a letter at some point also from their German tax office. We have so much KYC these days. It's really hard to cash out money without going through some form of KYC process. Banks have AML processes, anti-money laundering. So once you have a lot of cash or bigger transactions coming into your normal day-to-day account, they will start asking questions. Then you have to report to your bank, and your bank has to give that report to the BaFin, they give it to the BAFA, and they give it to the local tax offices. So also here is some information stream. It's slow, but I'm very certain that at some point tax offices will find out. I said at the beginning, we're all here for the Lambos. Also, that might cause problems with your tax office. Even if you manage to do everything like without KYC, without any AML processes, you pay your Lambo in Bitcoin, and then you need to register it, and then the tax office knows, because they just have, they are getting really good at collecting data. And if they see your income is whatever, 2,500 euro a month, and they see there is a Lambo registered under your name, then they will ask you, they will reach out to you, because they will think you worked like working without paying taxes. Then you explain them, oh, that was your Bitcoin or crypto trades, and then you still will have to do all the reporting, and then it's a real pain, because then they already you are already in the tax fraud department of the tax office, and that is usually not where you want to be. These guys are really uncomfortable. These guys are actually also really powerful. They can block your bank accounts and so on. Not a lot of fun, so better report it now. Work with tax optimized trading strategies. You can make millions without paying taxes in crypto. It's completely legal. Rather do that over trying to do tax fraud and try to try to do something without paying taxes here. We do have very good options. Also, there is a lot of options for losses. Losses in crypto can also be used against other gains you have. Also a very complicated topic. I don't want to go too much into detail. So the basics are there is like different circles in tax law, different income classes, and different circles can be calculated against different other circles. And then there is ways to calculate against tax declarations of the past and tax declarations in the future. And it is overall really complicated how to do it, but it is possible. And why not just harvest your tax losses? That is actually a thing, tax loss harvesting. And also here with a tax optimized strategy, you can use these losses in your crypto trading and use it to save taxes in other areas. And also that is a better way than to trying to do everything black or try to do it not with the tax office at all. And yeah. So quickly about what is our main product. So that was the kickoff for our online seminars. We will also start giving a whole series of online seminars. We got a little bit inspired from BerChain here to present our knowledge also in easy, understandable, smaller pieces. We do have more detailed seminars in different topics. They're already online. You can find them on our website or on Eventbrite directly. And that's like one product that's like super new that we just started this month, and that will we offer in the next coming weeks, the first seminars, starting from like a really detailed look into different DeFi topics. Like that's a more advanced seminar. Then we have one that is more for beginners, where we go into like all the very basics, where we do the standard trading case in more detail, and we'll go into a lot more questions here for the people. And also, as I mentioned, our main product is to work with tax advisors. More and more, we are opening up to also work with private people who reach out to us, starting from like briefings. They have a topic they want to discuss. Whatever that topic is, usually it's like some kind of very specific topic for them where they just have a lot of questions and they want to get rid of all their questions. And we discuss this on a one-on-one session with them. And the core product we're offering to our clients is the report, like we are creating for you or together with you, a detailed report and you can use for your tax advisor or for your tax declaration and for the tax office, and that you then can use for your tax declaration. That's like the main product. That's also how we started. And yeah, I see we have a lot of questions already. So
right. Yes, we do. First of all, Werner, thank you so much. That was so informative, so much information packed in like 45 minutes. Amazing. And I don't think we ever had so many questions before. I think people are very curious, very interested in what it is that you're explaining. So yeah, first of all, thank you so much for that. Let me actually moderate the questions and throw some nice ones in your direction. As we have so many, I would actually ask for very brief answers so we can go through as many as possible.
Yep, absolutely.
Right. So here's a very interesting one. If I work for a crypto startup and I get a token grant as part of my remuneration, there's a vesting period of 4 years with a 1-year cliff. Will I ever have to pay taxes for my grant?
Yeah, that's one of the topics where I could also do a 1 hour seminar. We were actually
I'm sure,
discussing
yeah.
that and said, okay, that's too niche. I mean, crypto is already niche, and crypto taxes is even more niche. But then people who get paid in salaries, it really depends. There is like a lot of different models how that can be structured. What is actually the payment in tokens? We had some cases where it was considered as a gift from the employer. It is sometimes part of the salary. It's sometimes part of a bonus. Like that all goes into that. Yeah, also this whole, how does it deal with a vesting period if I have holding periods and so on. I'll skip on that one.
Right, but I do suppose that like such a holding period can be built into the vesting in a way, right? So if it is
Yeah,
smartly designed, that could be
yeah.
interesting. Okay, great. Um, right, is the tax-free 1 year holding period only in Germany or other countries as well? I'm not sure how much you know about this, but anything you can say about that?
Of course, I'm also looking into other, like in the whole area, also in other countries. The 1 year tax-free thing is really German only. I've never seen any other country-specific regulation where it's completely tax-free. There is in the US, for example, they have different tax rates. They have a long-term and a short-term tax rate. It's you pay less taxes if you hold more than a year. But if I talk to other tax experts from other countries, they always envy us in Germany because it's really amazing that after 1 year you don't have to pay anything. You don't even have to declare it if you don't want to. So it's really that is German only. Maybe
Right.
not only. I don't want to say that. It's like a lot of tax laws in this world, but from the bigger countries and specifically US, and I've never heard of any other country that has a similar regulation. So yeah.
Right. Here's another specific one. If I use a crypto credit card, pay with USDT, do I have to pay tax on each transaction, or is that immaterial? So basically, credit card linked to USD, like Tether, if you will.
Yeah. I mean, there is a like formally correct answer and a simplified answer. The formally correct answer is yes, you should, because it is a taxable event as it is USDT and a stable coin, and USDT is actually, yeah, it is kind of stable. Let's be honest, there will be no big fluctuations. So you always have to pay taxes on gains or losses. And if it's like 0, you bought it for $1 and you sold it for $1, there is like no difference. Then of course also USD and euro is not 100% stable in a kind of short-term thing. So if you say, okay, you top up your credit card, your crypto credit card with the money you need for the next months, and then you spend it, I would say it's not worth going into the details here because it will be just like cents or maybe euros we're talking about here. There is also a completely tax-free amount if you have gains of less than 600 euro. That's like a simplification. Every like it's a like hard cut. If you have 600 or less, you don't pay any taxes. If you have more than 600, you would pay taxes for everything. So it's not the first 600 is free. It's like if it's under 600, it's so little, we don't really care. It's fine, basically. Simplification from the tax office because they don't want to be flooded with like everybody who goes to a flea market and sells their used socks. So that's like the regulation here. That like for a certain amount, you don't have to report. And let's not forget, this is a regulations for all kinds of assets. That's not crypto specific. So every private asset you buy and sell, and therefore it's a simplification, but also for us in crypto, very useful to say, okay, smaller things, or I wanted to try this and that. And I didn't do really anything within the tax year, but just played around a little bit with some new tokens or some new protocols. It's tax-free.
Okay. A very different question. Do you think there's a structural lack of enforcement or strukturelles Vollzugsdefizit regarding the current way of taxation of cryptos?
Yeah, I can label that as an expert question. There is somebody who has some knowledge that is actually a law case going on. that therefore the whole taxation of this whole field, like if that law case goes through, everything I told you, you can forget, everything's wrong. So there is a law case going on. It's also very interesting to keep your tax case open regarding that. But by keeping it open, it's also a bit risky because it can go to your advantage if that law case goes through and it turns out we have a lack of enforcement. Like for the, like, let me repeat the question in simpler words a little bit. The basic question is it legal to pay taxes on that if it is not possible that the tax office could do that by themselves, and also to do it the same over all people? Like we have something like you need to treat equals equal,
Right.
like as a general rule, and therefore that the one person who reports it would be the stupid one because he pays taxes. The other one doesn't report anything, can avoid it, and the tax office can never find out. And that's the basic problem behind it. And therefore it could come up with the question, is it legal to tax it at all if we're not sure that it is done equally over all people who have done that? It is a good way to keep your case open if you want that. Some people say, yes, I'm waiting for that because maybe I have a small chance that everything is tax-free. Others say, no, I'm actually fine. I have most of my stuff tax-free anyways. I prefer that this is final and that also the tax office can't change. Once I keep it open, also the tax office could come and say, oh, it's not final because you filed a complaint because of that ongoing law case. That is a reason to file a complaint. You don't have to sue yourself. You can wait for another law case to be final. But it's a bit risky, and it depends on your personal case. It's an interesting question. Let's see what the court decides.
Ongoing developments.
Yeah.
Right? So is it, would you say it's required or advisable to report a crypto trade even if it's tax-free? So you held it longer than a year?
That is regarding to what I explained with the 2010 slide. You don't have to. Technically, you don't have to. It's totally fine. You have a lot of clients who say, okay, they wanted to understand it. They don't see the need to file anything. They're very sure that everything is tax-free. The advantage of filing is, that's what I said before, once the tax office would have the chance to have a different opinion, from there on it's final. If you don't file it, then there are always these small off chances that that a law case goes through that says it's a different opinion and we're not in that income class, we're in another income class, and so on. So you have, I would say, a tiny little bit more of risk if you don't also report tax-free transactions.
So, I mean, what you're saying, you don't have the finality, like it's not final, right? Okay.
Right.
Okay. How would you have to deal with rewards? For example, BAT tokens from Brave browser or prize money at events?
Also here, always remember we are really, really early. There is like no one opinion on that. There is different opinions on what you might do. It depends in this case a little bit of it's like the airdrop where you don't have to do anything. You just have to have your Ether address, for example, and you get your airdrop on it. And then there is the other example where you have to do you have to sign up for something, or you even have to watch a video, like for example, Coinbase Earn programs and that kind of stuff. I mean, Coinbase Earn is like euros, forget about that. But overall, that class where you have to put a little bit of effort in, and you kind of have to see where you are. The more effort you put in, the more it is income because you had to do something for it. If it's like a pure airdrop, let's call it, where you don't have to do anything, it was just there, you didn't ask for it, tax-free. And then you can argue for everything in between. And of course, you in doubt want to, of course, argue more in the direction of tax-free. Also, some people say they want to go safe, they're happy to pay taxes. They argue in the direction of they want to pay taxes for it. Also fine, sometimes happens that. So
Interesting. Okay. How about gas fees? Are gas fees deductible expenses for traders?
yeah, everything that is like related to your income, you can deduct, no matter if it's like exchange fees, if it's gas fees, trading fees, if it's your ledger, if it's your coin tracking account, if you attend one of our online seminars, no matter what it is, you can deduct it as long as you can prove it has really to do with your income here. So yep. Keep a list. There is some costs you will forget over the year, and that by the end of the year, you remember everything you spent.
Great. Okay. Yeah, let's take a few more questions. Well, they keep coming in as well. What does a tax report look like? Is that an Excel sheet? Or
yeah, there is no formal requirements right now for what a tax report has to look like. It can be in the form of an Excel sheet. That would be the most basic. I would say that is even the standard up to 2017 because there was nothing else. Yeah, but it can also be a lot more. Like what we are providing is like an overview over all the assets, over all the transactions, all the definitions. Like also the tax office needs the chance to understand what's going on. So really we start with what's a blockchain, what's a Bitcoin, what's a crypto assets. Then we start with a whole set of definitions. How do we think that is taxed? Then we have a whole pages of definitions, how we calculated all the gains, what happened, and so on, and all the like report how we did all the special cases, like there was staking, there were airdrops, how did we tax those, why, what was the legal basis for that decision made, and so on. So it can be from as simple as a CSV export from an exchange to a Excel sheet to as really complicated as a, we call it Gutachten, like a full report, I would call it in English.
Right. Okay. Do I need to declare crypto when I have traded it and lost it on an exchange?
Depends a little bit what the question is exactly, because it could be like you lost it while trading, or you lost it because the exchange got hacked, scam, whatever. That's two different cases.
Right.
So,
Let's assume this is about the exchange got hacked or doesn't exist anymore, or perhaps you lost. I'm not sure if that's the same thing, but perhaps got lost, as in you lost your private key.
Yeah. All right. That would be the same case. That's actually not so fortunate in Germany, because let's use the exchange got hacked and all your assets are gone case. So you traded there, all the gains you made, let's assume you made gains, you still have to pay taxes for. Then the exchange got hacked and you lost everything, but the losing money or losing assets is not a taxable event. If you lose money that you hard earned from your job on the street because your 20 euro bill falls out of your pocket, not tax deductible. So here, worst case scenario is really you need to pay taxes for all the gains, and then your gains are gone and your assets are gone, and you still have to pay the taxes and you don't have any assets. So that's a little bit worst case scenario. And there's like some ways around. Also, this case makes it a lot harder for the tax office to prove. You could argue you don't know your gains because all the documentation is gone too. It's very unlikely that the tax office is able to get documentations from a hacked exchange. It's tricky. There is way around it, but that is like the worst case tax scenario in Germany, that you have to pay taxes on your gains and lost all your assets.
Okay. Shall we do 2 more questions? What do you think?
Yeah.
Do you want to pick one that you find interesting and I pick one?
Some familiar names, nice. So Maria asked, hi Maria, really great webinar, awesome content at a very approachable level. Are other costs relief methods acceptable, such as LIFO or HIFO? If so, what is required to use those methods? I talked about FIFO, first in, first out. There's also other methods to calculate what is like the original cost of that assets. For example, last in, first out or highest in, first out. In Germany, if we talk about business assets, then we have to use LIFO. So we have to distinct between private and business assets here. The tax word actually says for assets in foreign currencies, FIFO is mandatory. So now we could argue it's a crypto asset. It's not a foreign asset because it's not considered a fiat. A lot of other cases already told us that this is not the case. We cannot treat it the same. And therefore, we could argue there is basically no regulation. From a practical perspective, FIFO is most of the times the best because that's how you fastest get over your holding period of 1 year if you always use the oldest bought asset. Therefore, it's in most cases also the tax best. And with good argumentations, you are able to get in others. Highest in, first out is not something we have in the German tax law at all. So that might be a bit critical. LIFO is something that works. We also had cases where the tax office didn't accept LIFO at first. It was a very special case. Everything was under 1 year anyways. And there we had to argue a bit that, but then it did work out in the end. So also a little bit tricky. Like you see, once you go into the details, everything gets a little bit more tricky than I just explained.
But I think what you're saying as well is that certain things can be argued for with the tax office,
yeah,
right? So
yeah.
so if you can build a proper case, you can bring it forward, and it's up to them, of course, to accept or reject it.
Yeah.
But you can make your case towards them. Okay.
Right. Yeah.
Okay, let me take a last one, which is more about an opinion, to be honest. So do you find that there's sound tax law on crypto tax, or do you find that there's still a lot of gray area in which law needs to catch up? What is your opinion on that?
Clearly gray area and a lot that needs to catch up. Like, for example, we know that there is a group of people from different tax ministry and tax offices. Like we have the state office and all the local tax offices. And there's a group of people working on the topic of taxes for cryptocurrencies. They were supposed to provide us with a guideline paper, and that guideline paper was supposed to come out last year fall. So they're like more than 1 year overdue, and they are still talking about more or less the basics. So we talked to some people who are in this group and who work on that paper, and they're not talking about staking and yield farming and lending and everything the crypto scene is talking about right now. They are still talking about like what I considered as the basic case. You're trading, mining. Mining is basically outdated in Germany because it's not efficient anymore. So I don't think anybody's starting a mining company in Germany because it's too expensive and too high regulatory. And that's the level they're discussing right now. So they have like still with what is promised, even that have to catch up. And there is a lot of things that we're just interpreting right now. There is law cases going on. We talked already about Vollzugsdefizit, like can we tax crypto overall at all? There's law cases going on. Is Bitcoin and other crypto assets the same? Because everything we heard right now is only about Bitcoin. Like if some state office talks about crypto, they always talk about Bitcoin.
Right.
It's like they haven't even realized that there is more than one cryptocurrency. They're so far behind. And therefore, there is a lot of stuff open to interpretation. We can use that in our advantage because also the tax office is open for interpretation. We're definitely using that. It's a great chance also for us. But overall, it would still be great to know, okay, we can rely on that, we can depend on that. I think it would be great for also innovation, for investment. If I could tell people, yes, do staking because that's the tax outcome, that's what you have to expect, and so on, people would be a lot happier than what's right now. It could be this, it could be that, but we can do this and that. It's all like building your case and arguing and so on. So yeah, it would definitely be nice to have more regulations here and to have a better guidance.
Right. Well, thank you so much, Werner. That was so informative in terms of your webinar and so many great answers to these questions. I'll answer one more question, and that is, can this session be found online? And the answer is, well, we still need to make sure that you agree, but in principle, we post all our webinars on YouTube, on the YouTube channel Bearchain. I'm sure if you type in Bearchain in YouTube, you can find it over there. So that is the first thing. Also, we have as Bearchain, we have more events, and we just announced a series of events at the end of this month where we look at blockchain use cases in 5 different verticals. We're looking at supply chain, mobility, public administration, etc. So everyone here is invited also to join those sessions, and we also do these member webinars with our members of the association, like we did today with Werner from Pekuna, more often. So please join those as well. If you want more information on what Werner is doing, I'm guessing your website is the best source of information, right?
Yeah.
Right. So pecuna.de, and also you find contact information about Werner and Pekuna over there. You can also join the Bearchain Slack channel. So if you go to bearchain.com, you can find everything that there is to find about Bearchain. So first of all, thank you so much, Werner, once again for this fantastic webinar. Thanks everyone for attending and for your great questions, and hope to see you again at one of our next events.